Let's get right into the main question. Are we heading to a real estate and recessionary crisis in Canada? That's the question a lot of Canadians are asking right now. They're feeling stuck, rents are rising, mortgage costs are absolutely crushing some families' budgets right now, and the dream of home ownership for a lot of people, honestly, just feels further and further away. Now, whether you're renting or you're wondering, will you ever own any real estate? Or you're a homeowner looking to make your next move in this crazy climate right now, the real estate market seems to be harder to navigate than ever. And I feel like I'm saying that on every single episode and every single one of these podcasts. Meanwhile, every single headline that you read just basically speaks crisis. And that's not something new. Meanwhile, every single headline seems to be elevated to say crisis at all times. And while that might not necessarily be something that's absolutely new, we're in a state right now where the news is essentially screaming bloody murder at every sign of a potential recession, downturn, or change in the marketplace. With news coming and information changing, the data just doesn't stop coming in. And the big question people are asking is, what do I do with this data? So this episode is focused on cutting through a lot of the noise. CMHC just came out with a massive home affordability report, which was, I don't want to say groundbreaking. It was probably almost more confirming what we already know and we thought about Canada's housing supply issues, and specifically affordability. The episode that we're going to try to The information I want to break down in this episode is about cutting through the noise and helping you build some form of a real strategy, despite what's happening in CMHC's reports and despite what the market says about values going down and interest rates changing on a regular basis. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow. What's up? And if you don't already know, it's Alex McFadden here from Flow Mortgage Co. And this podcast is basically just for smart Canadians who don't want clickbait and don't want fluff and want to cut right to the noise. So today in this episode, we're going to get right into what CMHC's housing supply report might actually mean for real estate and house prices. Plus, I took out some key points that actually sounds like it meant something for me. And I especially think it'll resonate with most Canadians as it relates to what's happening right now. The second thing that I really want to key in on today is why rate headlines are really misleading right now and why they're actually going in a direction that you might be surprised by despite a lot of the news and what it's saying right now. And the last thing is that what are the average Canadians, and I don't even want to use the word average, what are Canadians doing right now as far as their mortgage options and how are they thinking today as far as mortgage solutions? So basically, number one, we're going to cover the affordability trap, which is how real estate and rent costs are completely crushing budgets right now, the decision dilemma that most Canadians are having, why they feel paralyzed to make a move in this current climate, and the ownership gap, which is who's going to benefit to buy and get in this market and how is that gap going to be tightened up so that more people can get into the market. So let's just get right into it right now. CMHC's report doesn't make the evening news, but it really should because the highlights are the root of the affordability trap. And I've broken down some of the information from the report and some really interesting things that maybe, again, aren't going to be surprising for some people listening to this, but perhaps they really should be. Some quick stats. We already know some of this, but in case you don't recall, in Canada, we need between 430 to 480,000 new homes per year. In 2023, we built 240,000 units. As of today, we have an annual shortfall of 200,000 units, and it seems that right now, the number of units that's coming available is going down. And this isn't a forecast. This is actual numbers and a reflection of reality. Every single year, we are falling shorter and shorter, and prices and rents keep drifting further and further from reality as a result of what's happening right now. Now, some interesting numbers that I found in the report. Toronto needs a 70% increase in new construction. Calgary is doing, generally speaking, pretty well as it relates to construction, but they're still about 45% under what their target is right now. Montreal, which I had no idea, but they have the biggest affordability erosion since the pandemic. So since 2020, Montreal has done worse than anybody else. And Vancouver is severely constrained right now in its current climate, as well as other areas. The one area which is an exception, which I found somewhat interesting, is Edmonton. That market has been on fire in the last year, but it's actually starting to slow down. We're starting to see a little bit more regular supply and demand in the Edmonton market. The big barrier right now in this marketplace is that we need more trades, we need faster permitting, and we need more affordable housing for builders. I don't know if you saw the reports, but in the last week, we saw massive layoffs in Vancouver from one of the largest developers, West Group, where they reportedly laid off over 150 people, with obviously calls for the marketplace changing, not being able to develop as much. And from a first person anecdotal experience, I've heard from a number of new development marketing firms that they are having significant transitions in the development space, meaning essentially developers are walking away from projects left, right, and center, or just basically backing out and saying, we will wait, which isn't a good sign from a supply perspective in this current marketplace. The truth is, you can't fix affordability without fixing supply. And right now, we're not even close to hitting those numbers. It's actually comical to hear where we're at right now. Now, I'm going to pull up CMHC's report here and have a quick look at this. Now, one of the interesting things about the CMHC's report, and I'm just going to read through some of these key points. It says, first, the time it takes to get an approval for and to build new housing means that a 2030 timeline is no longer realistic. That's a statement, not a surprise. While building a new structure may take 1 or 2 years, getting the approvals to rezone land is a multi-year process. To reflect the timelines, we'll begin presenting on our rolling 10-year horizon. As a result, they estimate how much housing is needed for 2035. And again, as I mentioned before, 200,000 units short per year is nowhere near the worst of what they're dealing with right now. In addition to that, they were showing the average growth of real estate. And while many are anticipating a crisis of prices, if you will, it's not happening, and they're not seeing it. If you look at over the course of the last 5 years, even despite the fact that 2021 was a crazy anomaly, values are up across the board all over the country, depending on the location, the city, and obviously the property type. Rents, in addition to that, while they have softened between 2025 and 2024 from where it was in 21 and 22 and 23, still up over the 5-year average and significantly up since 2019. Across the board, affordability is completely dissolving left, right, and center, and there doesn't seem to be any clear fix in place, which is what they're basically suggesting in this report. There is no real solution, none. And the fact is, the supply issues are not going to be resolved based on having these mobile homes or manufactured homes that the government is currently thinking. Now, let's talk about how the supply factors and affordability factors move into what's happening in the current interest rate market right now. Now, for a lot of people, they're thinking about the current rate market as suggesting that interest rates are coming down. And for a while, they were coming down. We saw yields drop, we saw the swaps drop, we saw the market moving favorably up until essentially the beginning of April. But since that time, we've seen the market make its way steadily and slowly back up. Specifically, if you're following the current marketplace, and if you do follow the 5-year bond yields, which is a great indicator of fixed interest rates, you'll note that we're just about surpassing the 3% mark on the yields, which is something that we haven't seen happen for over 4 or 5 months at this point right now. That essentially breaks the trend line, which means that we're not seeing fixed rates go down anymore. And in fact, it has, clued into a rebound on the fixed rate market. All this to say, essentially, the fixed rate market is changing. Now, from a current market snapshot perspective, depending on if you're a high ratio mortgage borrower, which is less than 20% down, or an uninsured mortgage borrower, which is more than 20% down, 30-year amortization, a refinance, the rate market has gone up by about 0.25 to 0.35% in the last 6 weeks alone. And as I mentioned before, if we do break that 3% barrier, we're going to see the market continue to increase at a higher yield. If we're using average, readily advertised interest rates, not the lowest rates that you can find in the marketplace, on an uninsured side, we're seeing fixed rates hover between 4.39 to 4.79% advertised. And yes, you can get lower interest rates, but that's advertised, and that is significant because we were seeing advertised lower than that only just a few months ago. The variable rates, we've seen the discounts essentially erode, looking at advertised rates of 5.5 to 5.6% and holding right now. The bond yields are pushing up again, as I mentioned, which is signaling the rate cuts are not going to be imminent right now. Now, the reason that we're seeing these rates holding at this point right now is that Well, it's a combination of factors. One, inflation has remained sticky, especially as it relates to wages and services. Oil prices are surging again because of what's happening in the Middle East. It's up over 27%, and that is going to have a direct impact on our current marketplace. And of course, the Bank of Canada is essentially waiting for a substantial or sustained reduction to inflation before they even consider any kind of rate drops. Now, from a historical perspective, and as a counterpoint, in the Gulf War and the Iraq War, oil spiked, but mortgage rates remained flat or dropped. Rate cuts themselves only dropped after economic downturns, not before, which is an interesting counterpoint to what we're seeing in the current marketplace. So the question mark is, does what's happening in the Middle East actually have a direct impact on the current rate market, or is everything just going to flatline and wait to see what's happening from an inflation perspective? Now, depending on what side of the fence you stand on, you might argue, well, that inflation is going to increase because of the oil prices, obviously, and the tariff threats, which are still ongoing. And if you do believe that is the case, then you will probably still continue to see upwards pressure on the bond yields. In fact, the current markets are projecting fixed interest rates to go up by over 1% over the course of the next 5 years. And while the truth is, predicting a 5-year outlook is fool's gold, it's not something that's really worth doing. At this point right now, it is not surprising to suggest that there is some realistic possibility to see that fixed rate market continue to increase. Now, right now, we're essentially stuck in a little bit of a waiting game and a holding pattern. But the truth is, the cost of waiting could be higher than the cost of acting smart in this current market right now. So if you are someone who is thinking about buying, getting pre-approved, or get refinancing, it's probably a good idea to start those conversations now as opposed to waiting, especially with the current market dynamic of what's going on. Which leads me to the next point. What is the real impact right now of real estate prices? Now, let's get honest. Be honest, there is no one size fits all outcome in this current market and climate. But the truth is, high interest rates and low supply still equal interest rate increases, despite what you're seeing in this current marketplace. And crazy enough, this is actually what we're seeing in some suburban markets. Now, I will put a caveat. It's not that I'm suggesting that house prices are going to continue going up left all across the board because of what's happening right now. But historically speaking, with the supply, if it does continue to go down, if people do remove their homes from the marketplace, if we do see that constraint occur over the course of the next couple of years, because there isn't as much building and the demand stays just where it is right now, then no doubt we will eventually see prices rise and renters will convert to buyers because they want to escape what's happening from an inflation perspective. Because essentially, what will eventually happen is that a lot of these properties will get swallowed up from renters. And then, of course, the market will reset. This happens all the time, and it does happen, and it has happened historically speaking. We all know the truth is you'll never be able to time the market, because if you try to time the bottom, it's probably because you're trying to catch on the way up, and vice versa. If you're trying to sell at the top, you're probably not going to do it because you're doing it on the way back down. But in this current marketplace, it's really hard to predict where things go, other than to suggest there are so many dynamics right now pointing towards an upward trajectory once we get through the thick of all of this current inventory that's on the marketplace. And I was listening to a podcast earlier today where they were talking about the fact that across the board, when they were applying these price reductions, they were getting offers on properties. So it's not like there aren't people out there looking to make offers. They're just waiting for the marketplace to pick up. And when that continues to happen, if we see that continue to happen across the board, then the market will find its way ahead and we will see things start to pick back up again, because the supply will start to diminish at that point. Now, if we do see modest rate cuts right now and reduction in supply, the supply will probably lead to a steady growth market, not a crazy growth market, which will most likely be the outcome if the BOC continues to hold the interest rates for quite some time. Property values will slowly inch upward, and when confidence continues to return to the marketplace, which is, again, not surprising in this current marketplace, but I think people just have this mindset that it's just going to continue to go like this forever. Now, the third scenario could be that if we see a deep recession, it will mean that we do see a short-term dip in the marketplace, but most definitely not a crash. I mean, when people think about crashes in our current marketplace, they think about 2008, and it's important to remember that in 2008, that crash was a US crash. It wasn't a Canadian crash. It was very different here. We did definitely see stagnation, and we saw markets basically flatline for the better part of a few years, but it wasn't a crash like a lot of people think. And it's been a long time since we've seen that. So If you're waiting for a crash, the truth is you're probably going to miss your window and prices might flatten, but access is really what's going to start shrinking, particularly as the supply itself lowers down and down and down. And again, in this podcast, and again, I'm not trying to suggest that you jump out there and buy the first property you see because you think the marketplace is going to turn around right now. What I am suggesting is there are going to be a lot of people who will wait and they will see the market take off and wish they had made an opportunity to get ahead, not only because of price points, but also because of the actual properties that they want to live in, which is the forgotten thing. Most people don't think about. People actually want to live in certain types of properties in certain locations. And as the supply diminishes, you'll see that part of things go away as well. Now, investors are positioning themselves, smart investors are positioning themselves to win in these markets. I'm seeing more investors come out of the woodworks in the last couple of months than I had seen over the course of the last year and a half. And there's a lot of reasons for that. One, obviously the rate market. Two, they're usually more in tune to the marketplace. And three, I'm seeing more of these investors look for different ways to create multi-unit properties than ever before, whether that be a house with creating a second suite, or looking at a duplex with 2 suites, or even a triplex with suites at each level. It seems to me that investors are still looking to get into the marketplace and still believe in long-term value, but they're looking to get more creative around different ways to leverage multiple units and properties. I ask you then a question, how do you actually take this information and go into a marketplace and move forward? Because the truth is, it's not about predicting the market, it's about preparing for it. And so there's a few key things that you should be asking yourself. Number one, is my current market, the market that I want to buy in, and not the market that I see on the news, is it underbuilt or oversupplied right now? For example, buying into GTA or buying in Victoria, prices may rise over the long term simply because inventory won't recover. Now, I'm not saying that GTA you should rush out to go buy a 1-bedroom condo, but over an extended period of time, of course, they will eventually recover. I think in those markets, you want to be safe and really smart in what you're buying and where you're buying it, but know because of the higher population centers, typically will rebound in a shorter timeline. Now, the alternative is if you're buying in Red Deer or in Saskatchewan or Saskatoon, anywhere really for that matter, you might have more time, which would create less urgency in the marketplace or a little bit more time to actually go shopping. The other factor to consider, we talked about the interest rate market. And if interest rates actually start to go back up again by, let's say, 0.5% over the course of the next 6 months, on a $700,000 mortgage at 4.5% versus 4.99%, that's a $230 difference, which obviously equals thousands of dollars in interest per year. And this might not break you, but it could lower what you qualify for, and it could lower what you could purchase, but it also will be money that you're basically throwing away and wasting. So I think one thing that people forget, particularly in an increasing rate environment, if this is the case, when we're seeing rates go up and we're seeing property values decline, it of course could cost you more money in total interest costs, depending on what those rates look like. Another factor to consider is what happens if prices rise, 5% or 10% while you wait, because you're going to wait 2, 3, 4, 5 years. A $750,000 home could be an $825,000 home. That's a $15,000 increase in down payment, plus an extra $250 per month, and maybe a bidding war on a property. And I am not suggesting to you right now that you're going to see a bidding war on a property at this point right now. All I'm suggesting is that there are people that are going to wait. They're going to want to wait. Let's wait 2 years. Let's wait 3 years. Let's wait 4 years. And there's a very good chance that depending on the property type you're looking for, it could get scooped up in that timeline. Now, I'll be really clear. There are different regional considerations, different property considerations. You're buying a single family home. It's going to be very different than a 1-story condo downtown. But at the end of the day, this information really does apply in these types of markets. Another factor to consider is if you do decide to purchase in these markets, what is my exit strategy? Can I refinance in 2 or 3 years if the valuations do go up, if interest rates do change and go back down, and or if I do want to take advantage of the market because I buy something and I see values dip in certain areas, can I rent out this property and purchase another if I have additional money in savings, or even leverage it from that perspective? Now, the truth is, in these types of markets, people are always asking themselves the questions about how to time the market, and you do need to be ready for multiple outcomes. I will say here that all this information that I'm giving you today is not leading to you saying, I need to buy a piece of real estate right now. It is leading to you thinking and understanding that we do have a severe supply shortage coming up, and there is going to be a major decision based on where the rate market is going, as well as what happens from a property value surplus or in this case, deficit. CMHC itself, essentially in this report, is throwing a red flag up and saying we have no way out of this thing. What are we doing as Canadians to get the market moving and get real estate built? Because Canadians need affordable freaking housing. And I see it every single day where I meet people who are hard workers working 8 to 10 hours a day, making $30 an hour. And they look at me and say, how the heck am I supposed to buy in this market? I can't buy a house for $350,000 or $400,000 in any market that I'm in right now. And I don't blame them. I mean, I'm going to tell most of those people that you have to start somewhere and you have to get into the marketplace. But the truth is, we're not making it any easier on ourselves, which means that the affordability trap is a real thing and it's growing and it's not going to go down. And my advice on that is the same advice that you would always ever hear, which is get in as soon as you can and stay in as long as you can into the current marketplace. And some people might not want to hear that, don't care. That's my advice. It's something I've done, and it's something I've seen countless other people have success with. And more often than not, it will work out for you. The second thing is that the current decision dilemma with the interest rate market and the housing market is causing people to freeze. But clarity in what's happening right now is power. And if you know where the rate market is going and you know where eventually supply is going, it's easier to make a decision in this current marketplace. The ownership gap is widening. And these reports from CMHC are saying it. And I'm hearing it from Canadians every single day saying, I'm never going to buy a home. So people are going to step through it. Some people are going to get there. It's just there's going to be less and less and less. And we're going to see a situation where we do actually have this nation of renters. But if you're listening to this right now and you're in this decision place right now, ask yourself the question, am I sitting because I'm afraid right now, fear of the market, or am I sitting because I actually have a plan and I am going to purchase something? Because all I see is people commenting on these videos and commenting on these podcasts and saying everything is full of shit and the market's going to crash. Yet here we are today, and we've seen these messages for the better part of the last 10 years. So I ask you, people who think it's going to crash, do you actually own real estate? Have you bought real estate? Or are you just consistently arguing that it's the worst thing ever to have? Remember, there's a lot of people out there who are buying this for themselves. So they have a sturdy home to live in and they don't just have an investment property. And remember again that the Canadian government also knows very clearly that the vast majority of Canadians have most of their wealth tied up in their homes. So they're not going to let the market crash either, contrary to what you actually think and believe. So I hope you enjoyed this episode. I got a little heated at the end. The primary goal here was to advise you specifically on what's happening from an affordability perspective, especially since CMHC is saying that this is a concern. Who's getting into the marketplace right now, why the market is actually misleading as it relates to interest rates, and how you can build some form of a plan to move into this market sooner than ever before. If you found this information helpful and you want to find out more about working together, just DM me and I'll book in a strategy session to help you understand and create clarity around what your options are. You can find me at The Mortgage Pug on Instagram, or you can send me a note on YouTube here today. Thanks for listening. We'll see you on the next one.